Hello and welcome to the Westpac Macro video. I'm Sean Callow and joining me today, senior economist Matthew Hassan. Welcome, Matthew.
Morning.
Okay, so a lot of economic data, obviously very mixed, I'd say, in the past few weeks in Australia, and some very different signals really in terms of housing too. Obviously not necessarily impacted in the same way as other sectors of the economy. So, Matt, how would you characterise the data we've seen in the state of the Australian housing market?
Yeah, you're spot on there, Sean. It's we've got to be very careful in reading data at the moment, and particularly so when it comes to the housing market. I think the general picture is of a more meaningful contraction starting to show through, particularly around building activity and prices. But I think with all the data flow at the moment, we need to be very careful, particularly around issues like timing. Australia, obviously, we had the COVID lockdown in the April month, and so market activity was essentially shut in the housing sector for a month. But that's affecting the timing as that appears in the data flow. And some segments, there are lags involved. So disentangling all these things is proving to be pretty tricky. The most timely data we have, for example, around weekly auction results, that's back to sort of business as usual in terms of flows. So auction clearance rates in Sydney around 63% for the latest week, 61% in Melbourne, a little bit softer. But volumes are back to where they were this time last year. So June last year was sort of coming out of the federal election, so it was quite a subdued market at the time, but it's a far cry from that shutdown in April. And the second most timely data is around prices. We got the June wash up from CoreLogic. That also included a wider measure of transactions, and that showed that volumes in the June month jumped 36%, basically returning to pre-COVID levels. On the price side, I think this is where it gets more nuanced. The prices in June were actually much softer. They declined 0.8% in the month, and the monthly declines tipping up slightly, so they were down about 0.5% in the previous month. And I think it's a combination of sort of lags in the housing market, but also the dynamics in this adjustment are a little bit different. Normally when we see a housing market adjustment, it's high interest rates and a tightening in credit that drives a sudden stop in activity. Whereas what we've got this time around, as we've sort of said in the past, the housing downturn is much more of a collateral effect of the COVID shock itself. So it's coming indirectly through the shock to labour markets and to household incomes. And many of those dynamics are likely to come through quite slowly, in part because we've got these policies in place to cushion the blow, the JobKeeper and JobSeeker policies cushioning the blow to the labour market, flowing through the household incomes. But also we have temporary loan repayment holidays, which are slowing what would otherwise be quite a rapid transmission through urgent sales as stressed borrowers look to offload properties into a weak market. So around prices, as I said, for the June month, definitely a touch softer. Interesting that the detail continues to show slightly faster price declines in the Melbourne and Perth markets. Melbourne prices down 1.1% for different reasons. Melbourne was coming into this correction from a much stronger starting point. Prices had recovered all of the 2018-19 correction and were back near previous peaks. And we've seen very strong momentum ahead of us. So I think we're a little bit more stretched in the Melbourne market. Of course, Melbourne has had a more difficult COVID virus, and then we're seeing a material second wave in Melbourne, where the number of cases is actually above their April level. So it's likely to be a much slower, it's a deeper shock and a second shock likely in Melbourne. With Perth, it's more that it was such a weak market for multiple years. It's still a very fragile market coming into this. And even then, we're talking about the difference between a 0.8% decline and a 1.1% decline. So nothing it's not like a capitulation kind of decline. It's just a little bit softer around the edges. Around the construction side of things, this is where it gets a lot trickier. So this week we had an update from the ABS on dwelling approvals, very sharp decline for the month of May. Now, of course, April was a lockdown, but approvals held up reasonably well that month. because of lags, that approvals in the month reflected applications in a couple of months prior. And that's still a bit of a factor in May. The headline approvals number was down over 16%, and high-rise approvals look to be down about half, by about 50% month to month. That takes the total level of approvals to around an annual pace of around 150,000. So that is quite a material slowdown. That said, the non-high-rise segments showed more moderate declines, and are likely to see more weakness going forward because of those lagged effects. There's also, I think with dwelling approvals, we're seeing a bit of a disconnect that people may be getting the approvals through processed but not actioning them, putting projects on hold, or even shelving work that's underway. So we've got to, as I said, we've got to be very careful with interpreting some of this data. For what it's worth, we do think there's a lot more weakness to come through on the construction side. I said, we're around 150,000 annual pace with approvals at the moment. We think the wash up for this calendar year will be about 145. So we'll be tracking about 120,000 a month through the remainder of this year. It's likely to remain very choppy. Aside from these lagged issues and the sort of indirect flow through of the housing construction slowdown, we also have other policy measures that will be providing some support. The government's home builder schemes offering $25,000 grants to eligible owner-occupiers looking to build new homes or make major renovations. Reportedly, that's seen quite a strong take-up, particularly in some states like WA, where state governments have doubled up on that grant. But that's going to add some offset to this. It's going to be quite a messy year, I suspect, and reading the housing market is going to be a bit of a fine art, but it still looks like we're headed into material correction.
Okay, and just quickly, as far as the immigration outlook is concerned, obviously currently the outlook is, if anything, slipping a little bit in terms of when we might get a return of permanent migration, and even the international students. It looks as though that'll be very, very cautious and small scale. So does that just, what sort of weight would you place on that as a factor in terms of the housing demand over the next year or two?
So I think it's really important, perhaps more so for that medium term year 2021 picture. The migration story could be the sleeper out of the shock from COVID-19. Clearly with travel bans in place now, we're going to have zero migration. But if and at the moment we're moving through a really important phase. So the re-emergence of the virus in Melbourne is really testing our ability to restart things like foreign student inflows. If our quarantine and our tracing and isolation systems aren't capable of tamping down a renewed outbreak of the virus, that's going to make it much harder for those sectors and those migration flows to start up again. So it's a very big source of uncertainty. And I think to put some numbers around it, I mentioned before, we expect 145,000 dwelling approvals this year. Prior to COVID-19, underlying demand, so population-driven demand for new housing, was around 175,000, 180,000 dwellings a year. We think population growth will slow to around 1%, so from 1.5% pre-COVID. 1%, that's essentially along the line, thinking that foreign student flows resume. So we do get through this difficult period and we find a way to enable that flow to start up again. That would take underlying demand down to around 130,000. So, that's already further below where we're sitting for approvals this year. So there is already an issue there. If we were to see foreign net migration inflows drop by the 85% that the government's talked about, that would take underlying demand down to around 100,000. If we were to see it turn off completely, it would be lower still. So it's a really big deal for the medium-term outlook for dwelling construction. Clearly, the home builder policy is a key strategy for reopening the economy, in that while we're still dealing with some legacy issues around COVID, sectors like housing, the government's looking to sectors like housing construction to provide some further impetus because it's able to. It's not as directly affected by virus restrictions, and it's an essential service in terms of the construction work. and so it has the scope to provide some support there. But if the underlying population growth is materially weaker, that makes that a bit of a trickier strategy. If you push too hard on it, for example, and you build well above that 130,000 a year, then you can eventually start to run into issues of oversupply. I think that's still a long way off, but that could change the dynamic for year 2, 2021. And obviously that affects a key growth driver that the government's looking to. So yes, I think that the migration story, absolutely watching it very closely. As we're seeing a clear test of whether Australia can reopen parts of that migration flow under a quarantine system. And we've had a clear setback in Melbourne. Whether we can, I think there's a learning process involved here. So can we improve this process so we don't get repeated setbacks that would really be troubling in terms of the virus? So I think that's a really huge aspect of what's going on at the moment, and really it speaks to 2021's outlook.
Very interesting. Thanks, Matt. Obviously very fluid in terms of even just the past few days on what the states are planning on borders, particularly on Victoria, where certainly a bit of a step backwards, but opening elsewhere, particularly in New South Wales and Queensland in early July. So thanks again very much for that, Matthew, and thanks to everyone for watching, and we'll speak to you next week.